Welcome to everybody listening in on this call. Today we have the pleasure to present NNIT. To help us through today's presentation, we are joined by CEO Per Fors and CFO Carsten Ringius. The event today will primarily cover the Q2 22 results, which also was followed by a revised guidance upgrade. So it looks like pretty good momentum right now. As always, do not hesitate to ask questions. You can do it in the box down below. You can do it in Danish or English. If you do it in Danish, I will try and translate to the best of my ability. Do it through the presentation. We will see if it fits, or else I will get all the answers all the questions in the end. But for now, I think I will hand the call over to you, Per.
Thank you, Michael. And we are here to give a short update on NNIT. And as some of you recall, last year we announced that NNIT going forward were to focus on international life science and also public sector in Denmark. To enable that and to accelerate that, we decided to divest our infrastructure operation. We announced the deal in June last year. And then it took us almost a year to conclude the deal. And the reason for that being that the company that we were to sell was not a standalone company. It was a very embedded part of our business. But we made that deal complete on April 28th at a price that we think in a good way reflect the high value of the business. At the same time, we announced the new strategy or the updated strategy for the remaining NNIT, or the new NNIT as we have chosen to call it. And that is a business that will focus on life science and public sector in Denmark, and also selected part of the enterprise market here in Denmark, primarily within the Microsoft area. Then we have operated now almost 1 quarter in the new setup. And it was a great pleasure for us to actually give some updated guidance. We will come back to that for the remaining of the year, meaning because of the performance we see in the business, we're actually faring slightly above that we had anticipated. Looking at the Q2 numbers, we saw a revenue growth of 15%, out of which 11% was organic, and we operate an operating margin of 5.9%. We believe this is a good first step for the new NNIT, and we will come back with the guidance and also with further details on the later Capital Markets Day. But it's always good to be off to a good start, which we think the first quarter is a good sign-off. If you go to the next slide, when we actually decided on the updated strategy, we also launched a refined organization and also refined reporting structure, where we actually divide the business in 4 regions, which is Denmark, and the Danish part of the business does not include the life sciences business, or the European life science business resides in region Europe. The region Denmark consists of the group company Scales, our business to the Danish public sector, and also a consulting unit. The European unit is actually contained in Denmark, Switzerland, and Ireland primarily, but also operation on a number of other countries. The US part of the business is built with the group company Excellis, and also the migration powerhouse and the rest of NNIT business. And then they have the Asian business, which contains of China and of Singapore. These units are fully independent units which carries their own regional overhead, and also contains all the salespeople which resides in the different geographies. We also have invested in a global unit which contains primarily the solution development, because when we have our global solutions, which are most often based on partners, which solution we implement, and we wrap NNIT services and capabilities around that, we don't want to do that in 4 different places. We do that in one place in a global solution development organization, which is a very mean and efficient organization to focus on the services which are truly global. We truly believe that this new way of organizing our business and also reporting on our business gives a much increased transparency internally, how we run the business, but also how we present the business to the outside world, meaning folks like you guys on this call. Now, Carsten will give a little short kind of update on the performance of the 4 regions the second quarter.
Yes, our new financial disclosure is following our new strategical split of our business into 4 regions. If we start with Region Denmark, as Per mentioned or alluded to, life science is covered by Region Europe and thus not part of these numbers for Region Denmark. So Region Denmark is primarily the public, as well as some private companies, as well as our scales Microsoft house. If we look at the performance, we see into Q4 or Q2 a very strong revenue growth of 22%. This is also partly driven by a particular strong development in our group company scales, where we see growth up to 30% quarter-over-quarter. If you look at the financial disclosure, we are operating on, as Per also mentioned, on gross margin level, but also on a regional operating profit level, as well as a group operating profit level. If you look at the trajectory here, you see that we have been able in Region Denmark to actually improve our earnings quite well quarter-over-quarter. We have been able to both reduce, you can say, the regional cost as well as the corporate overhead cost allocation. So very strong growth from Region Denmark. And if we look at the outlook for the remainder of the year, we see a strong pipeline supporting, you can say, the upgraded guidance that we have been able to give in the market. It is contracts like Danske Nationalbank, ATP, but also Nordlys that has been, you can say, fueling the business through the quarter. And we also see some strong wins, for example, for scales, now securing a contract with Treeshape that would be a new significant F&O implementation that scales will be implementation partner into second half. So good performance in Region DK. If we look at Region Europe, as I mentioned also, this is life science in Denmark, but we are also geographically represented in 9 other countries, serving life science clients across the value chain. What we have seen in Q2 is somewhat stable revenue development. What we do see is some macroeconomic volatility also impacting our customers' decision process, slowing down the decisions to actually make huge investments. So we have been seeing some wait and see attitudes from across our clients here. We have been very focused on our cost discipline and ensuring the optimized capitalization to ensure that we can keep our gross margin levels at the historical level here. But as you can see also here, we are on a positive trajectory. If you look at our operating profit, we are on a positive slope in actually improving the profitability in the business. And if we look at second half of the year, we also in Region Europe have a solid pipeline that you can say supports our now upgraded guidance for the year. So a more stable development in Region Europe, but with improving profitability. Going to Region US, we see a very, very strong positive development. It's a very specialized life science focus we have in the US with a good strength in R&D and also quality, and now with beginning activities within production IT. We saw very strong growth of 36%, very good performance from our group company Excellis Healthcare. So excellent performance here. And again, besides the growing gross profit margins, we also here see a group operating profit increasing on a very positive level compared to quarter last year. We see an increase in almost 25 percentage points on the profitability. So extremely good performance here in region US. Jumping to Asia. Asia, our geographical footprint is in China and in Singapore. And if we start with China, we saw as part of our, you can say, migration of our global delivery center from China to the Philippines in 22, some requirement for recalibrating the setup in China. What we are looking at now is quite some negative macroeconomic developments following, for example, the real estate development in China, and also caused by low investments in China. We see some restrictions in companies investing in China. So here we are on a more, you can say, wait and see basis in relation to how the negative climate will impact our pipeline going forward. What we do see, though, is a very strong progress in Singapore. And as to the China business, we have taken some actions already now to ensure that our capacity is at level with our pipeline, and of course closely monitoring the pipeline into the second half to ensure that we optimize the business. So these are, you can say, running very quickly through our new financial disclosure in the regional split. If we look at the totality, we see again here the trend, of course, of improvement in profitability. We saw an improvement compared to last year of around plus 10 percentage points, but also compared to the previous quarter, an improvement in 1 percentage point for Q2. All in all, giving us an operating profit margin of 5.4 in the first half of the year, and a strong growth on revenue, around 15% quarter over quarter. So that's the fast update on the financials, and then jumping to the outlook.
Yeah, a few words on that. I touched upon that in my introduction, but as you are aware of, on August 26, we had the privilege of doing an kind of positive profit warning, lifting our revenue and earning outlook for the year, following actually improved performance in the first half of the year. The profitability are impacted that we have a higher revenue, but also we have improved utilization in most of our business units, not all of them. We've also been able to reducing the overhead cost, which was a key undertaking when we were splitting the two companies. And also we have a good development within a number of our business areas, like our public business and custom application development, and also within our production IT, but also within our group companies. Special items are expected to be related to earn-out payments in connection with the completed acquisitions. And as you know, we have appealed that decision by the Danish Business Authority, but the final verdict has not yet come. Well, if you look at the numbers, we have lifted our revenue growth for 23 to be 15% versus the previous announced 10%. And also that our operating profit margin that previously was 5%, we have uplifted to 6%. And also our special items are unchanged and expected to land around 70 million Danish kroner. With that, we have kept our promises to be talking for 50 minutes, so we have time to answer also your question. Thank you very much.
Perfect. Let's start by some questions then, Per. The first one, where are you taking market share in Denmark, the private or the public sector? I guess if I look at your 22% growth and looking at others, it kind of looks like you are taking some market share. So is that correct? And where are you primarily taking it?
It's actually underpinned by a fairly equal distribution within our public business. based on a number of the wins we did last year, and then the upselling on those that Carsten mentioned, like Nationalbanken, ATP, and others. And as you know, there was also a little bit hit that we took in ESSO, where the client actually decided to withdraw the tender. We hope to win that later in the year, but that affected actually our numbers in Danish public sector this year. Also scales, which are working across industries, not very much in public, primarily in the enterprise sector. So there's a high growth in scale. I think Carsten even mentioned the word 30%, but we were fairly close to that also in the public sector, while the third part of the business, which is more the consulting part, were growing a little bit south.
Perfect. And then there's a question, what is the reason for so low growth in Europe, and when do you expect this to grow again?
I would say Europe is the one unit that it has been partly affected by the big transformation that we have been in, where we're splitting our market presence to be, in the old days, encompassing the whole IT delivery, including infrastructure, to be cleaned out of infrastructure and be focused on consulting only. That's one reason. And the second reason is the one that Carsten alluded to, that I mean, the high energy prices and also the high inflation rate in Europe has impacted to some degree the investment done by the big pharma companies, where they have been a little bit hesitant by executing some of the plan that was previously decided, meaning for us that some project has been postponed and also delayed. We see a positive trend going forward for the remaining of this year, which is partly then embedded in the uplifted forecast.
Perfect. Yeah, because if I was wondering, you mentioned the macro, but Europe is also part of the life science. They are not that macro sensitive. So is it more like what we are hearing from other IT companies that they deal with other problems, so they delay the decision process to do more IT or more than it's a macro view that they need to cut their budgets? Is that the same view you have on Europe, or is it slightly worse that they're actually cutting away projects for forever?
No, it is. We experienced that they wait. You can say have a more laid back approach towards taking a big investments decision. So it seems like they are, you can say, following the development, looking at inflation, interest rates, and are not, you can say, eager to take big investments because they are focusing on other elements. So these investments are postponed, you can say, or decisions are postponed. That's what we hear.
Yeah, but on the other hand, Michael and the rest of you, I mean, our life science portfolio has different components. In production IT, that's very, very closely interlinked by investment in or upgrades of the production facilities to produce the actual drugs. Those are the ones that are most effective. It's quite large investment decision. Those are the ones that are sometimes delayed or postponed. One other part of the business, like regulatory affairs, the clients don't have any choice. They need to stay at par with regulation. And also in R&D, I mean, there needs to be a lot of investment into R&D in order to provide the next generation drugs. So it is not across the line. It's just in part of the business, primarily around production IT, actually, that you see some postponed investment. Yeah,
that makes sense. The building costs are going up and everything. So yeah, you are. That makes a lot of sense. That answer there. Perfect. Thank you. In US, what is driving growth, and maybe more, can it be replicated in other regions? It seems like you have very strong growth. I know there has also been some. I guess you have had a good effect of your M&A in the US, but is there something you could see be replicated by that higher growth? Is there something you can move from that region?
The US business basically contains three different parts that are collaborating, but they're also fairly separate. Firstly, you have a group company, Excelis, which are actually working with supply chain, and more specifically with serialization in the supply chain, where are based our offerings on one of our partners, where we implement the solutions and also taking care of the maintenance. A very profitable, fairly stable, high growth business, because this is driven a lot by regulation, because serialization enables the client to be able to track and trace where the drugs has been produced, where it's consumed, to be able to take action when needed of different reasons. Yeah. The second part of the business is actually migration of large data masses, which was a group company, Alliance, which is now integrated into NNIT, and now it's called the Migration Powerhouse. That is working, in a very specialized segment of the market when clients are to migrate big data masses. And the third part of the business is primarily around regulatory affair, quality, and safety. So there are fairly three independent businesses that partly work on the same client base. So we see some potential synergies across in the US. But it's quite hard to take the Excelis part and export into Europe, even though Excelis actually have a smaller European part. So there are some potential to upgrade that growth to other business units. So we are working with it, but we see primarily the synergies actually within US. Last comment is actually that we see a growing demand within production IT in US, where we have quite little capabilities. So here we're actually working with, getting into a lot of the competence in new opportunities from Europe primarily, where there's a lot of competence through both asset control and also the prime for services acquisition, with highly qualified people to support clients with implementing new production systems. So there are things happening across, but it's also fairly isolated to each geography.
Perfect. Then there's a question. With your new business segments, are there not a danger that you will lose global sale? That your US is focused on selling in the US and not pushing so much, which I guess it's very much, this is also about accountability and driving growth and driving efficiencies in the different regions. So I guess you could lose the wish to drive global sales across the different global regions from the single division you have.
As part of our new strategy, we have a, you can say, a global unit also focusing on global sales excellence, and you can say is primarily supporting the regions with global RFPs as a support function. We also have an incentive structure that is incentivizing, you can say, the entire organization to work towards increasing the overall financial performance of NNIT. So despite, you can say, we have a regional head for US, they have a strong incentive also to ensure that we actually grow the entire business. And many of the customers we actually have are also represented, for example, Novo in several of our regions. Hence, you can say, already prompting a lot of cooperations between the different regions. And if you also look at how we actually deploy our consultants into the region, we actually have consultants working across the region. So while the revenue is owned by a region, you have consultants potentially from several regions working on, you can say, delivering that project. So I think there's a lot of mechanisms in place that will both support but also drive incentive to not only look at a regional level but actually look at the overall performance of NNIT.
No, I think it's very, very put, Carsten, and maybe I added to that we have in a global, we all the clients, the main responsibility for all clients resides in one of our three business units. So there's one global account manager, like take Novo as the most obvious example. So that's residing here in Denmark, naturally. But the global account manager coordinates our activities across the regions. So when we interact with Novo, when that's needed, we operate as one global company. But having said that, when we do business in China, a lot of that business is actually driven fairly independently from Copenhagen. But sometimes when there are big tenders that goes across the unit, they expect us to demonstrate that we can act as one global company, which we can whenever that's required by the client.
So those projects that is driving across the global organization, the cost is landing at headquarter cost. Is that correct? So they are, you don't get this where you want to.
No, but I mean, let's take another round on Novo. I mean, yes, there's a lot of business decision taking here, which encompasses only the Danish part of the business. But there are some global deliveries and then there is always an owner for that has a counterpart in Novo at global level. Then we take deliveries from the different units, and the profitability of that part that's done from China lands in China. The part in US lands in US, and then they share some cost for this global organization, which is extremely slim, by the way, that actually drives the global account management.
Perfect. Is there still any cost in this quarter so shouldn't be there after your divestiture? I guess you talked a lot about stranded cost, I guess, in some of the earlier quarters. Are there still something affecting here, and how should we look at how clean are the cost lines that we are seeing? Or I guess maybe below all the segment or the regions, your corporate cost and so on.
I can tell you that the sort of immediate organizational restructuring that was to be done, that has been concluded now in Q2. So we have, you can say, put in our new organizational that is to be put in place after the divestment. But if you look at our total cost base, we have a cost program that is not complete yet. We are having several levers to actually lower our total cost further. That is both being, you can say, of course, more efficient in what we are doing through a global platform. We are now acting as a global company, global consultancy company, and we see potential efficiencies in operating more aligned on global procedures, putting in place a global ERP system supporting our business, providing a strong platform also for future acquisitions. And we see some, you can say, some right sizing of our facilities that would also provide us some cost savings. And then, of course, this new financial operating model that we have gives us a better platform for also doing performance management, having higher transparency across our business, also giving us opportunities to optimize the business. So we have still some levers to use over the next period to increase or to decrease our cost.
So I know you don't guide on the different lines, but if I should interpret it, you actually have quite a way, and we as investors should actually expect some of those cost lines that will go further down in the coming periods. Is that what you are telling me?
To answer the question on the stranded cost, I think we have addressed a huge part of that.
You have addressed that, but I guess some of you still have a lot of maybe efficiency projects, if I understood you correctly. Is that correct?
We can still find cost savings. That's the communication. Yes.
Perfect. Then there's a question: will you present new financial target on the Capital Markets Day?
We will share a financial ambition for our strategy period.
Perfect. And then finally, there's a question regarding the cash flow. Why is the cash flow? It's still very negative. What is actually what is the reason behind that? Because I was also wondering, because I guess your new model you were kind of indicating that cash flow should go up because you would need to invest less because the infrastructure business was driving more, needing more investments.
Yes. Well, first of all, of course, the free cash flow from the divestment has been used to also repaying debt, paying out our revolving credit facility. But we also entered the year with high utilization of factoring agreements that we have now, you can say, paid back as part of the divestment. So that has caused the cash flow as you see it presented in our H1 report.
So looking forward to the coming years, that should not have an effect again. Is that correctly understood?
That is correct. This is of course one-time occurrences that we have repaid our factoring agreements and that we have repaid our non-current credit facilities. So that is a done deal.
Perfect. I think we got through all the questions and looking forward to hearing from you soon again. I think on the 18th September you will have a Capital Markets Day, I guess, with as you said, new ambitions and a lot of ground to cover. I guess that's also going to be very interesting, and we will also have an event here where we will cover some of the main subjects on this Capital Markets Day. But thank you to you, Per and Carsten, for taking us through today's presentation and answering questions.
Thank you. Thank you.